All right, let's dive right into this explainer. Today, we're putting National Grid's massive infrastructure footprint through the absolute ultimate valuation gauntlet. We are going to look at this absolute titan of the UK and US energy grids and evaluate it using the legendary investing frameworks of some of the greatest minds in finance. Acting as expert investment analysts, we're going to pull apart their newly released fiscal year 2026 financial data and see what's really going on under the hood.
Here's our roadmap for today. To figure out if this power giant is a buy, hold, or sell, we're going to filter its financials through 6 steps. First, a company snapshot and the Buffett lens. Second, the Peter Lynch framework. Third, the Graham valuation. Then, a base case DCF, a few alternative models, and finally, we'll wrap it up with our synthesis and verdict.
Starting right off with Section 1, Snapshot and Buffett lens.
So, before unleashing the gurus, let's get our baseline data for ticker NG. Now, since we don't have a live trading price in our historical data file, we are explicitly assuming a current stock price of £10.50 to run our calculations. For fiscal year 2026, the company posted a really solid underlying earnings per share of 78 pence. They also declared a total dividend of 48.49 pence per share, which, by the way, was bumped up right in line with UK inflation. So what we've got here is a classic, highly regulated, dividend-paying utility generating strong earnings.
And just look at the sheer scale of their network. Stretching across New York, New England, and the UK, it is wild. For Warren Buffett, the absolute first thing he looks for is an economic moat. In National Grid, they have an almost impenetrable, monopoly-like moat. I mean, it is virtually impossible for a competitor to just show up and build a parallel electricity transmission grid, right? That is a massive, massive checkmark for Buffett.
But, when we run through Buffett's full checklist, things get a little tricky. The moat and the earnings consistency, highlighted by an 8% EPS growth this year, are fantastic. But Buffett also demands a high return on equity and manageable debt. Their ROE ticked up to 9.8% this year. For Buffett, who usually loves to see numbers consistently in the mid to high teens, that's kind of borderline. But the real elephant in the room is the debt. That staggering £44.16 billion debt pile, yeah, billion with a B, would definitely give him serious pause.
And it actually gets worse when we calculate approximate owner earnings, which is Buffett's preferred metric over standard net income. National Grid just reported a record capital investment of £11.6 billion for the year. Because this massive capex vastly outpaces their depreciation, they are burning serious cash just to maintain and grow the asset base. They literally have to constantly pour billions into the ground to keep the lights on and transition to green energy, which pushes their true free cash flow deeply negative. So for Buffett, unfortunately, this is a clear avoid.
Let's switch gears to Section 2, the Peter Lynch lens. So how would the legendary mutual fund manager categorize this utility beast? Based on CEO Zoe Yuzhnovic's explicitly guiding for an 8 to 10% underlying EPS compound annual growth rate, Lynch would firmly peg National Grid as a stalwart. It's not a hypergrowth tech flyer, and it's not a dying, slow grower. It's a massive, established powerhouse offering highly visible, reliable, long-term growth and a progressive dividend.
Now, the crucial metric here for Lynch is the PEG ratio, the price-to-earnings ratio divided by the growth rate. This was his favorite way to value stalwarts. Let's do the math. By taking our assumed stock price of £10.50 and dividing it by the 78 pence EPS, we get a PE of 13.46. If we divide that by the midpoint of their expected growth, which is 9%, we land on a PEG ratio of 1.5. Lynch generally wanted a PEG of 1.0 or lower for a screaming buy. So a 1.5 suggests the stock is fully valued for the growth you're actually getting.
Lynch would also dig into the balance sheet and ownership. Factoring in that heavy £44.1 billion debt, even with a recent Fitch upgrade to a BBB rating keeping their investment grade status intact, it's still a heavily leveraged utility. Plus, institutional ownership for a stock like this is practically guaranteed to be incredibly high. Lynch actually viewed that as a negative because he loved finding hidden gems the big Wall Street funds were ignoring. Putting it all together, Lynch would likely view National Grid as a solid hold for income, but it just lacks the undiscovered high-growth traits he loved.
Moving right along to Section 3, the Benjamin Graham valuation lens.
Graham always started with his qualitative defensive investor checklist. And honestly, National Grid breezes right through most of it. Adequate size? Absolutely. It's a massive global enterprise. Earning stability? You bet. Their highly regulated framework ensures incredibly consistent revenues. Dividend record? Exceptional. They just paid out 48.49 pence and aim to grow it in line with UK inflation.
And even with that high debt, their regulatory gearing is managed around the 61% mark, which actually satisfies Graham's baseline for financial condition in the utility sector.
But let's look at the actual math. Graham used a very specific formula to find intrinsic value, the square root of 22.5 times the earnings per share times the book value per share. So we pull the total equity of £39.33 billion from the balance sheet divided by the 4.946 billion shares outstanding, and we get a book value of 7.95 pence per share. Plug that 78 pence for EPS and 7.95 for book value into Graham's formula, and it spits out a calculated intrinsic value of 11.81 pence or £11.81.
Now here's the catch. At our assumed current price of £10.50, that intrinsic value represents just an 11% margin of safety, and for Benjamin Graham, that is simply not enough padding. He typically demanded at least a 25 to 30% margin of safety to protect against unforeseen market shocks. So Graham would likely hold off on this one and wait for a dip closer to the £8 mark before initiating a buy.
Section 4. Base Case DCF Valuation.
Let's step away from the gurus for a second and build a traditional discounted cash flow model. To make this credible, we need clear assumptions. We'll use a 5-year forecast period because it perfectly aligns with management's new commitment to invest at least £70 billion over the next 5 years. We'll use a 6.5% weighted average cost of capital, which is pretty standard for a stable, regulated utility, and a 2.5% terminal growth rate to mirror long-term UK inflation targets. But remember the big caveat here. Just like we noted with Buffett, their massive capital expenditure means near-term free cash flows are going to be deeply negative before they generate long-term returns.
Let's look at the sensitivity table to see how this plays out. Right in the middle, under our base case assumptions of a 6.5% discount rate and a 2.5% terminal growth rate, the DCF yields a fair value of 10.80 pence or £10.80. Sure, if interest rates drop and we use a 5.5% discount rate, the value jumps up to 12.50p. But in our base case, sitting at 10.80p against an assumed price of 10.50p, the DCF is basically telling us the stock is fairly valued right now.
Section 5. Alternative Valuation Models.
Look, DCF models can sometimes struggle to accurately price companies with massive, multi-decade capital expenditure profiles. So let's cross-reference this with 2 alternative valuation models. Since National Grid is an absolute dividend powerhouse, the dividend discount model is super relevant here. By taking their current dividend of 48.49 pence, assuming a 7% cost of equity, and applying their long-term growth rate of 2.5%, the DDM points to a fair value of £10.77. It is actually crazy how closely this aligns with our DCF base case.
Alternatively, we can look at a comparable multiple analysis. If we assume a standard, regulated utility multiple of roughly 15 times earnings, which is totally typical for highly secure infrastructure assets, and multiply that by National Grid's 78 pence EPS, the comparable analysis suggests a price of £11.70. So, this specific model actually shows some decent upside potential from our assumed 10.50p entry point.
Finally, Section 6. Synthesis and Recommendation.
Okay, National Grid has officially run the gauntlet. We've applied the qualitative guru checks and the rigorous quantitative models, and here is our synthesis matrix. The consensus here is incredibly tight. While the comparable multiples suggest a buy and Buffett is a hard avoid due to the heavy debt and negative owner earnings, almost every other model aligns perfectly. Peter Lynch's PIDGE approach, Benjamin Graham's strict intrinsic value formula, our discounted cash flow, and the dividend discount model all point to a fair value clustering tightly between $10.77 and $11.81. Therefore, at an assumed price of $10.50, the math dictates that National Grid is currently fairly priced. It represents a textbook, rock-solid hold for investors seeking a reliable, inflation-protected yield.
National Grid is navigating the greatest energy transition in a generation, committing £70 billion to modernize the grid. The yield looks safe and the monopoly is impenetrable. But I'll leave you with this final thought to ponder. Is the unmatched safety of a guaranteed energy moat really worth stomaching the anxiety of a £44 billion debt load? That is the ultimate question you have to answer before adding this stalwart to your portfolio.